Hi, everyone. Welcome to our market talk here on YouTube. So 2 interesting weeks have passed. First of all, Happy New Year, everyone. Uh, I'm sure we wish you all the best in this 2023. Yeah, so we'll start. Interesting days in the markets. I was very busy today and yesterday as well. So finally, I see some opportunities to have some action in the markets, not only scalping, but maybe for some intraday risk as well, and building my spreads. So yeah, first of all, Raphael, we had bets. During our last show, we had bets. So what about them?
Yes, bet was regarding US oil. We wanted to know if we would be lower or higher versus the price from the previous show. So the price at the moment was 78.22. And Brian and I said we would go lower. You said we were going to go higher. So Brian and I were right. And the second bet was if we were gonna break the previous cycle low, and I think we didn't. Bryce said we would, and you and I said we would not. We are close, right? But not there yet.
Yeah, so I'm sure we have a lot to talk about today. Also, we have a new guest who will, I'm sure, will provide a lot of valuable insights. Okay, so let's start. So, Raphael, what you are doing in the markets and what are you trading and what are your views?
So obviously got squeezed today. I mean, this is a recurring joke with Europe. I mean, it keeps ripping. What was a reason to unload during the sell-off was the fact that on MFR, both DAX and CAC were unable to break trend. They remained bullish, were unable to even go back to neutral. So that was a red flag. I unloaded some. On the first bounce, I tried to reload. Didn't work, just getting higher and higher. So today with the news, I decided just not to do anything. So I will show you some stuff that I'm seeing right now regarding different things I'm watching. So, so the first thing, for example, was US oil. US oil has been working very nicely since we. I need to share the screen first, of course. Share screen. Up. Sorry, guys. Okay. So what was interesting was, I need to move this here. Okay, was yeah, since we got the dip in volatility here, it's been just non-stop selling. We had a small bounce over there. This is when we actually made the bet, I believe. Brian and I were talking about shorting oil, so at least that's one position that worked for me today. I think it looks good. I mean, the fact that volatility is rising and still a bullish trend in terms of vol shows that for now it makes no sense to be long oil, despite the narrative about China, etc., reopening, all the things you hear about oil. It's been a good bet so far, and vol still have room to run higher to the previous high here. So until I see maybe a lower high in volatility, I don't see any concern regarding this position. Another thing that I'm watching is, of course, the dollar. So I think it was the last day of the year was the first day we had an upside-downside ratio above 1 on DXY since the trend broke. So I took a shot on UUP after waiting months before getting in, and of course we got the bounce, which was interesting. But for now, volatility-wise, I mean, it's just doing a sideways action. I mean, volatility is high on DXY. It's just stuck very high and just going sideways. So for now, I would guess that either it's an accumulation phase and we just remain high until volatile trade catch up, and then we we would hope to see volatility go down. That would be that is my current thinking. But I expect more chop, at least until we get the vola trade to catch up on the volatility. You can see the same thing in Euro USD. So Euro USD, you had volatility has been crushed to the low since November, and that explains actually the move on Euro USD. We had a spike back to trade here. The question is, will it go higher? So the last time we had this kind of volatility action, it actually triggered the beginning of the bear market in Euro USD. This was the last time. You can see here. Will we get a repeat or not? I don't know yet. Euro USD gave a very good upside downside ratio on MFR for shorts. I think at some point we were at 0.18 on the last day of the year last year. So it was very good place to load on the short Euro USD. Now the only change I saw was momentum. We went to neutral momentum on Euro USD. Could be a signal of something bigger. I don't know. I would like to see the volatility in blue here rise above the volatility trade. That would be the signal for me that, okay, the next leg down is coming for Euro USD. Until now, I don't know. I'm not sure. So I try to manage the position very aggressively. Another one is the SPX. So 2 weeks ago, I mentioned the spike in vol, which was interesting. That was a nice setup to short. And now the issue is we're stuck in this range here, and you can see the volatility is doing the same. Volatility is stuck at the volatility trade. It's just doing nothing, just stuck there. We don't know if it's going to resolve with volatility going higher or volatility going back down. For example, in Europe, we had the same kind of setup here with volatility stuck, but it resolved with volatility going down. Hence the spike that we have seen currently in the CAC, but you will see the same thing in the DAX. Same thing. Volatility was stuck here and then just crashed. Hence the bounce. I don't know if I did it for NDQ as well. Yeah, NDQ is same. You can see volatility is there, just stuck. The question is, will it resolve the same way as before, or we just get another bounce, some kind of BMR? Another interesting stuff is gold. I've mentioned platinum and gold the last time, and I want to show you. So basically, what I do is I check the usual mean of the trade volatility of gold before we get a sell-off. So volatility trade is the white line, and you can see that anytime we get near this level, the red dots, you can see here, you can see most of the place, you will get the sell-off in gold. Doesn't mean that we're going to change trend, but we get a correction. So I missed the train here on gold. I have very small position in gold, platinum, and gold miners, but it's like I didn't have the confidence to go there because of the dollar. I had my brain wrapped around the fact that dollar should bounce, and I didn't want to risk taking gold. Because of this, now I'm stuck waiting for a correction, and the correction for me will come when volatility trade will come too low for volatility to keep going lower. Basically, what you get in this kind of scenario is volatility trade is compressing vol, and at some point vol has to explode to the upside, and you get a correction. So for example, here you had this, here you had this as well, and before you also had this. So I'm waiting now. Platinum looks the same. I marked the previous time we got to this kind of very low trade vol value, and anytime you get a correction, sorry, my computer is a bit slow, so you get here, 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 and we are in the same place. Currently, Vola trade is there. So my expectation is we will get a big red day. Can we get a trend break? I don't know, but at least I'm waiting for this to correct to some place where I would accumulate, and that would match maybe a signal on dollar to start to have this volatility go down. That would be my assumption right now, but I'm waiting. I missed the train, so I don't want to chase that high, so I'm waiting. Let me check if I mark some other stuff, then I can pass the baton. Yeah, you have also, yeah, the 2-year. So I mark the volatility here. You can see 2-year vol is like, it's beautiful. I mean, you can see our volatility is just being crushed since since September 21. No change so far. So I don't expect the US 2-year to do anything, but just maybe chop here, but I would not be surprised to see it go higher again. And you got the same setup on the 10-year. So yeah, that's what I'm looking at currently. Yeah, I need to show you the VIX as well. Then I pass the baton. So the thing I'm watching for VIX, and I think Donkey will go into more details with maybe a better tool for this, but what has happened so far in 2022 is when you get the trade of VIX, sorry, the trade of Vola of VIX near touching or right above it starts the trend of vol of VIX, this is when the VIX will bottom. Okay, I've marked the previous points. And currently now we are literally almost there. So if history repeats, and if we are still in the bear market, my assumption would be that soon we will get a VIX bottom, and it will be interesting to maybe purchase some puts, maybe short the whole market, etc. So when will it happen? I don't know, but we are near. I mean, you can see it's obvious for anyone who's looking. For now, hourly vol indicates that it wants to rise. So my expectation would be that here the blue line would rise somewhere here, and where VIX will be when this happens, I don't know yet, but that would be my assumption that putting some shorts on when volatility is in this place, maybe with Vola also of hourly in this neighborhood, would be a good place to start accumulating puts and shorting the markets for the next leg down. Okay, that's my thinking currently. So we have one guest today. It's we call him Donkey for anonymous reason. This is his nickname on Twitter, and he has been sharing content that is awesome. So that's why we asked him to come. He's got a whole different process, and you will see today all of us have different processes, but we all come to the same result. So that's pretty good. Maybe you can introduce yourself, Donkey, and maybe show some stuff to other people.
Sure, guys. Thanks for inviting me. I really appreciate it. You know, I love this stuff, so I was happy to join. Having a good time already. So, but yeah, I'll share my screen. I'll show you guys kind of what I look at. Let me go ahead. Can you guys see it okay? Just configure here. So yeah, I mean, I guess I'll just talk about what I've been looking at recently. It's been kind of a quiet period. I haven't really done a whole lot. The market's kind of just been stuck in the mud, trying to pick a direction, and I haven't really seen a capitulative move either way recently. So here's just a couple of my trades that I've done recently. You know, I put on a little bit of puts here. This is when VIX was down sub 20s. It was like 19, 18, somewhere in there. And the reason I put this trade on, here's my vol indicator here. So this is something a lot of people like to see on Twitter. So I'm always posting this. What I want to see here is red here, red here. You could see we haven't really gotten there yet, and I can actually even turn it on this is the instantaneous. So the white is basically the instantaneous sample, and then the other 3 lines are just moving averages of the white. So you can think of the white as the primary signal. And you can see, the reason I said this is a small put trade, it's just kind of a nibble, because even though we had VIX all the way down at 19, 18, you could see this risk on indicator here never really reached the same area as these previous tops. So over here, it got all the way up here, all the way above yellow. Up here, all the way above yellow. Same thing, even back here, all the way above yellow. And then here, this was the previous regime. So in this regime, we've been peaking out significantly higher on this indicator than we have here. So I saw that. I saw, okay, our VIX is low, but it's not aligning with what I want to see here. And that kind of was reflected here when we had, I ended up closing it about 2 days later. I hedged it out. Nice little trade there. But a small one. It wasn't really anything serious that I put on. And then all of a sudden we had VIX rise with the SPIX in that stretch. So you can see that the things are kind of out of whack. It wasn't really a clean vol entry. And then beyond that, sure, if you shorted up here, that would have been nice. But even up here on that, this was the CPI session. And I kind of put some notes here too. I didn't end up biting on that. Why? Because even though we had that big spike in deltas, your VIX had risen as well. So it just wasn't a clean entry for me. Sure, it would have been great in hindsight if I put some delta shorts on there, wrote it down. But the setup wasn't there. I didn't see the fat pitch, so it just wasn't there for me. So I didn't bite. And then beyond that, I took a little bit of longs here. Been scalping it recently, but again, nothing really that's moving the dial on my account. Just a couple small stuff here and there, and mainly waiting. So here's my other indicator here, and here's some further evidence. Here's where our other peaks were up here. This is a mean reversion. So this was vol up here. This is my vol indicator. This is my mean reversion indicator. So this is looking at trends with respect to realized volatility. This up here is looking at implied volatility. It's looking at the term structure. It's looking at the volatility risk premium. Here, we're not looking at implied vol. We're looking at trends, so moving averages, and we're looking at realized volatility. So what's occurred rather than forward looking. And you can see here similarly, these previous peaks we got up here in this orange to red territory. So if I saw something like that, I'd say, okay, maybe it's time to load the bus. Here we didn't really get there. We came up shy. Now, the question becomes, and here's where I, past few days I took a nibble at a long down here because I had this mean reversion. So that's where I entered this down here, scaling mean reversion long. So I took a little nibble there. I actually closed that out today. I posted on my Twitter. Why? Because we had mean reversion here, then we chopped sideways, and that kind of resolved those oversold conditions. I no longer feel like I have an edge on that, so just cut it. So what's left to do here? Now the question becomes, are we going to go up here? I don't know. I personally don't like to waste too much time trying to forecast. It's not really, I do. I mean, I think a forecast is helpful, but what's more important is forecasting your risk and your reward. And to me, it's all about, did you have the signal to enter a position or not? And for me, I still haven't had the signal. It came up shy up here, so I didn't enter, and that was it. So does that mean I miss a whole wave down here? Maybe. I'm willing to live with that. If that's the case, it is what it is. All you can do is enter based on your signals and exit when the time is right. I do think that the bears are still in control here. So MACD, this is kind of how I track my trend, just a really basic indicator here. This is bearish. I mean, you see some fading momentum. So are the bears losing some steam here? Maybe, but nothing confirmed. I don't think there's a confirmed bull trend here or anything. So I think we're kind of right in the middle of nowhere. That's my overall opinion, is we're just kind of in the middle, waiting for something to happen. If we come down a lot, maybe you get a long opportunity. Otherwise, you're kind of waiting for it to go up so you can short it. But right here, I don't think there's much to do. It's just a waiting game. Maybe you can nibble on some scalps here and there, but for me, it's just wait for your shot, wait for your pitch. And that's it. So that's all I basically had. Thank you guys for having me.
Thank you. I'm sure it was interesting. Okay, so Brian, what are you trading? What are you looking at?
Yeah, sure. So 2 weeks have gone by since the last meeting, and the bloody stock market's gone absolutely nowhere. So it's been just a awesome 2 weeks, I guess. Coming out of that big down move, I was fully grossed for that move. I haven't covered anything since then. So I like had the full portfolio on for that move, and through this 12-day chop, I haven't covered a thing. So that was pretty brutal today. It was kind of sucked on some of the days where we had a couple of up days. But in general, I haven't gotten anything that's told me yet that I should be really reducing risk from what I carried up towards the CPI day. So I'll share my screen here too and show you how the dashboard's closed today. Can y'all see that okay?
Yeah, we can.
Cool. Yeah. So the big thing I've been watching is correlations. Obviously, you're super into that too. And all of these big choppy days, we've stuck with pretty high correlations. Sectors are at extremes, both on the 30-day and the 5-day. Stock bond correlations are firmly positive, and those strengthened today. SPY UUP is finally back to a good negative correlation with room to run in the short term. So from here, I would really expect dollar and stocks to run in opposite directions. And so that's a really big thing given where dollar's at and kind of what you were saying, Raphael. So like, if we get Euro USD selling off from here and Dixie bouncing, that's a key signal for me that stocks should come under pressure, just working off of that correlation. And then SPY VIX has just been pretty soft in the recent correlation today. For some of the day, you actually had them correlating pretty positively, and just VIX really hasn't been able to hold a really strong bid even on some of the bigger down days we've had. And part of the reason from that is just kind of the gamma structure right now. So like we're really skewed to the put side. There's not many calls out there. I wouldn't say we're extreme. We're not. I mean, obviously with VIX at 22, like, yeah, the market is definitely skewed to the put side, but it's not an extreme positioning like we've seen in a lot of the lows recently. So for me, that's a bear sign. So that puts us in a negative gamma state. I have gamma flip staying at 385, and that's right where we failed today. And for the past, I think we've been up and tested 385 around about there 3 times. At multiple times at this point, and it's failed. It's going to go a little above 386, 385. Today we failed at 385, and then we come down to 380, which is a big put wall and also the absolute gamma strike. So in order for VIX to really fully bid here and us for it to catalyze the next leg down, we have to hold below 380. And we've dipped below, we've gone as low as 378, but we just haven't been able to freaking hold a move below, and that's led to this just really wide, very volatile chop that you've seen from 380 to 385-ish in that range. And because we're really still sticking in there, and I still have broadly the same signals that I had coming out of the drawdown with high correlations, us remaining in negative gamma territory. We're not really oversold from a range perspective in MFR. So on the near term, we have now downside after today. And then on the long term, we have excess long-term downside below. So, and that's working off of a neutral / a lot of stuff really hasn't even broken trend yet. A lot of the sector ETFs like XL, P for, if I go to my dashboards here, a lot of these names, for example, I'd say XLF, XLI, a lot of the more cyclical names, not tech has definitely been the underperformer. A lot of them haven't broken trend yet, which, some would say that's bullish. I would say that means that we haven't really gotten the selling yet in this drawdown to put some kind of firm bottom. And so the way I think about that is that you can't get some kind of sustainable BMR that really runs unless you come from these kind of oversold conditions, which we're nowhere near. And not only is that because you can see the trend skew here, we still have a lot of downside, but also because that trend skew is being calculated with neutral and some bullish trends. And so that means that there's downside to come. And if we do squeeze upside, it's not going to be another 1 to 2 month BMR. And so taking that together, also knowing that correlations remaining high, stock bond correlations firmly positive, really never went negative, even through this 2 weeks of chop, that kept me have the portfolio gross and just looking for opportunities actually to add more. So right about now, I'm pretty close to what I'm comfortable with having it in terms of towards max size. So I'm pretty bearish right now. Today, I didn't like what I saw today. I mean, I didn't like it in the P&L, and I would have liked us to see a more definitive breakdown coming out of the Fed minutes, but there's still some catalysts to get through this week. We have ADP, so another ISM report, we have NFP, and the minutes today, obviously they didn't really cause some kind of big squeeze. So they're not some positive catalyst that came out today. And the really interesting thing for me, now I'm no macro talking head. I listen to a lot of macro talking heads, but that's not my specialty. But what I've noticed in the data, as well as just signaling perspective as overall, is that we came off of the CPI FOMC meeting, and that drawdown really, it wasn't driven that much by the macro. I mean, one of the big things I've been watching is just the fact that we're pricing in still 25 bips at the next meeting, the February meeting. I personally, Ramadan's going to have a different opinion, apparently. I personally don't see that. I just don't see them slowing down that fast, just by the way that I've listened to Powell, and personal opinion on that one. Nonetheless, we're pricing in almost a for sure 25 bips at the next meeting. That means that the risk is the market still has to entertain the fact that they do 50 at the next meeting. And what we've seen is that pricing in more rate hikes has a correlation to pressuring stocks. And so the minutes didn't do it for us today. We'll see how they land out tomorrow after they had a day now to digest. But I think that's one catalyst. And then we're getting into earnings season. And though that is still a ways out, that's something we can start getting some pre-announcements. But the most near-term one I would say is Fed hawkishness to maybe push this next leg down below 380 and get us back on track here. And what I need to see to get me off this short train right now would be a move back to positive gamma. And so we haven't really seen any call buying. It's still a highly unstable market, as you've seen, with these consistent failures of 385. We're still in negative gamma. We're still in a put heavy market. You get any kind of overnight tape bomb and gap this thing down the next day, no problem. Additionally, I've got my target net exposure here. And so this scans all of the 350 tickers I load from MFR. And that one is also a signal for me for oversold, overboughtness. And you get it as good as negative 0.3 to negative 0.4, some of the best I've seen it. Negative 0.23 is a solid one. So, into the, especially at the highs today, and even into the close after stuff, came down a little bit, I have a bunch of short signals. And then one of the main reasons behind that is because vol came down actually pretty hard today. And I don't see some massive vol crush coming after here. The big pops that you've had after Christmas and after New Year's was people not wanting to buy protection before the holidays. So if we pull up Raphael's VIX, for example, where we put the bottom in back in December, and then we've had a few bids for vol, but the big ones after the big CPI, you bled off the call gamma from there. Big ones have been after Christmas and then most recently after New Year's. And that was people waiting, not wanting to buy protection until after the long weekend. And those people that bought protection, they're not going to give it back just maybe because the Fed minutes didn't crash the market today. They're buying protection for the next month and a half worth of catalysts, the Fed meetings, CPI reports, a lot of stuff that has to get through for the next month and a half. And that bid for vol, in my opinion, is going to remain steady. And so today we had a drop in vol that weakened a lot of my trend signals. You have a bunch of shorts here that I had. Unfortunately, I'm pretty at a large size, so I couldn't really press that much. But that is another reason that I stuck around on the short side today. If I get the gamma structure tomorrow and I see that calls are starting to get added and we move back to positive gamma, if I see correlations weaken into another attempt lower or even an attempt higher, and that would potentially have me starting to reduce risk as soon as tomorrow. So we'll have to see. Another big thing is Hurst exponents right now are just so weak. They're like the weakest buy I've seen all throughout the entire bear market, pretty much on SPY. It's one of the lowest points. And so that adds to this crazy choppiness. It makes it really hard to identify whether a move is going to stick both on the upside and the downside. And the way I'm reading it is just volatile chop. You can get the market just drop out. The floor could drop out tomorrow, and you don't know if that's going to trend or if that's going to stick. I'm looking to see some kind of signal of where Hurst might strengthen. I haven't gotten it yet. The only thing that Hurst have strengthened for me is within fixed income space. So like the only Hurst that are still like broadly above 0.7 are within fixed income. So TLT, IEF, those ones, they're all, TLT, for example, is a 0.81. So that one, and actually I got a pretty weak signal on that one today. So should be really interesting what bonds do here. I'm just not sure whether you need long end bonds to fall to pressure stocks anymore. I do think you need the 2 years sticking pretty firm. So the fact that Raph, you were saying the 2 year should be continuing to rise here, sticking firm. That was good. Credit spreads today, LQDH, HYGS, credit spreads are actually down. So LQDH closed red. And Raphael, I don't know if you've looked at this one recently on your signal, but I was looking at daily vola for LQDH, and that one, it's making higher lows and it's trying to break down. So we'll see if that one can break down. That one's highly correlated to stocks too. And you can see that correlation right here. That actually interesting. That correlation started to weaken a lot recently, especially through the December chop. You had spreads and stocks start to separate slightly. And so I would expect that one to recorrelate, and that has room then to bring some risk forward. Recently, VIX and bonds have been correlated pretty heavily negatively. That one is kind of confusing to me because you have stock bond correlations positive, you have stock VIX correlations negative, but VIX and bonds have been trading negative, strongly negative, and recently it's kind of separate here on the short side. So I'm not sure if that means that treasuries could act as risk off here if we have a big down move, or I don't know. I'm not sure. And you have IEF UPs now back to being just a limp duck. So I think dollars should be the predominant risk off vehicle from here. Whether treasuries bid with it, I don't know. Whether if treasuries bid with it, if that's bullish for the stock market, I don't know. It's really confusing right now. But that's what I'm looking at from a broad risk perspective. Risk continued to build today. I expected that it would fail intraday at 385. It did. Should fail again tomorrow, especially because Hearst are so weak. I don't see any reason this should continue. But if we had an update today, if we get Hearst strengthening tomorrow, then that could be something that could make me think that maybe we do get a trending move higher. But I don't think you have the vol crush there to start the year with everyone that just loaded up new hedges. So a lot of conflicting stuff. It's overlined by the fact that the stocks have gone nowhere for 2 weeks, so it's hard to really get a strong signal out of that. And so I remain growth short. I'm expecting this market to fail. And if it doesn't, we'll degrow some reduced risk and try for the next one. So that's where I'm at.
Very interesting. Yeah, Hearst exponent is the main reason why I'm still day trading and not holding stuff. Okay, Ramadan, I'm sure you have a different opinion than Brian, right?
Yeah, I mean, not too much. So I would agree with Brian on I think the bond and stock correlation is starting to deviate now, and higher yields doesn't necessarily will mean lower stock prices. I think the market could start pricing in lower growth rates for the longer term yields, which could maybe. Right now, I'm not getting any bullish signals on long-term bonds, but that correlation does seem to be on the edge. But on the other end, I am a little bit more bullish than everybody else here, I think. I'm seeing IVOL premiums increasing across the board. So that's another thing that a lot of people are hedging. So, and I want to share my screen here. Let's see. So this is something me and Vi worked on. Oh. So this is a cross-asset correlation indicator, and looking at the correlations of the market, we could be seeing a short-term bottom here. See that correlations are starting to diverge, and when markets are crashing, that's when you see the spike ups in correlation. So now that we're seeing some dispersion, I'm expecting a short-term bottom right here. On top of the IVOL premiums and my signal strength, I'm not really seeing much to short here. And also that we have a put heavy option expiration coming around 120. So around that time, you also have CPI coming out. You have Q4 earnings kicking off with financials on the 13th. So all that stuff we could be changing, but for the next, week and a half, I could see more upside than downside. And it's just also based on risk reward, you know, we've been holding that 3,800 support, large gamma strike. So to me, the risk reward is that's the low. Let's see if we could go higher. Also show you guys some of the signal strengths
Ramadan.
here. Yeah.
Sorry to interrupt. Can I ask one question? So you're saying like when that one diverged, it's bearish or it's bullish when those two, because those two lines are, oh, so you're thinking they diverge more, those two. That
No. Don't worry about how they diverge. Look at the blue line individual from the red line. The red line is S&P. The blue line is the correlation indicator. And once you see like we're getting close to that like 0.85, 0.9, that's when like, you know, you're crashing. Everything's correlated. Everything's going down together. But when you start going down, and we're seeing it going down here, things are starting to move, you know, as individual sectors and all that assets move in the market. So I'm seeing that as an indicator for a short-term bottom, that everything's not moving together down or up. They're not either crashing together or they're not short squeezing together. Each thing is doing its own thing. So that on top of the premiums, on top of my signal strength, and we have catalysts out in 2 weeks. So I could see the biggest pain trade is up, and risk reward also tells me up. We have that large gamma strike, we've been trying to dip below it, gets bought up, get below it, gets bought up. So not much to go over here today for me, but yeah, I am going like 0.15 net positive beta. I look at my portfolio beta and I'm 0.15 positive right now. And I don't usually go higher than that during a deflationary, stagflationary regime. I'll keep it like that's my max long. So let's see. And if we start breaking below 3,800, you know, we cut losses, start adding some shorts, and then that will be the new high for me. So we'll see. Probably might get chopped up around right now. Right now is a lot of chop, so I'm keeping my position sizes small. Yeah, so let's go over some of my signal strengths. So as you can see here, like most of these have been spies breaking out bullish. Don't worry about like how they move together. Just look at like the red line for the signal. So red line, that means it's bullish. Let's see. QQQ just recently turned bullish on. I know it's not as bullish, so it's really low, very low signal still. Look at the dollar though. Dollar is not looking good. And to me, I actually am also long the yen right now. So I'm looking continuation in that dollar downtrend, maybe some more consolidation. But right now I'm not bearish on the dollar, bullish on the dollar, sorry. So yeah,
okay,
that's
interesting.
the bull.
So this signal score, so what you need to happen for you to become bearish? Basically, what changes you should want to see?
Well, I want to see
Not only in the signal, but overall in the market.
Yeah, I want to see SPY under, you know, break the lows and stay under 3,800. So once it gets below 3,800 and I see it's not like getting bought back up really quickly or anything like that. And at the same time, I'm seeing the dollar also getting above, let's see, what am I looking at the dollar? You know, if I see the dollar getting above 105, 106, then I could see like, okay, you know, that's the end of we're going back down from here. But right now it's just been lower high, lower high, lower high for the dollar. Even that pop yesterday was still a lower high compared to on the 16th or on the 19th of December. So it's just been a series of lower highs still on the dollar.
Yeah, I agree with Ram on the fact that a lot of damage was done to the dollar on this down move. And now the question is, now the case is on the bulls because the damage is done. So now the question is, how long will it take to patch things up?
And the dollar doesn't have to crash from here for stocks to go up either. You know, it could just grind sideways and stocks could go up, you know? So, yeah, I just don't want to be long the dollar right now.
Okay, we'll see how it goes. I have a bit different opinion, but also I agree with some stuff, of course. Okay, so now let's see what's going on from a macro perspective. I'm sure Christopher has something interesting to say. So Christopher, hi. Well, what
Hi.
are you looking at?
Currently, just updating all of my models. Over the holidays, I had a little cold or flu, so it knocked me out. And for me, basically, now I start to share my screen.
Please tell us when the
This
CAC and the
one.
DAX will crash.
Yeah, I try to.
Please.
I try to. So Raf asked me to share my thoughts on the European macro side. So what you can basically see this in this chart, you can see the weekly, monthly, quarterly regime probability. So what I basically do is I look at growth and inflation regimes. And I try to use a leading indicator as the main growth aspect. And what's interesting is for me is that we're getting a slight stagflationary burst in the last week. So based on the monthly and quarterly regimes, there's really nothing into the range of the disinflationary side. But for the weekly regime probabilities, we're seeing that Germany, as well as Europe and France, it's the most dominant regime. And this is basically due to the fact that corporate spreads and corporate bond yields they are increasing in the first week of 2023. So this is a pretty good indicator for me for looking at daily inflationary changes. And what I basically get is we're seeing a lot of inflationary pressures around Europe. So you can see in Germany and Europe, Germany and France, which are basically the most important countries for me, due to the fact that they are heavy GDP countries in the Eurozone, and growth probability is pretty low in Germany and as well as in Europe. So there is no state switch there. From a regime strength perspective, it remains a short. What I try to assess with this indicator is that I look at a simple momentum indicator which uses higher highs. I try to use it as a binary indicator, and with this I use several machine learning indicators on my macro data and try to assess if the macro data supports recent equity strength. And this is clearly not the fact. If you look at the macro signal strength on the right side, we're seeing a weekly strength signals for Germany with 17.4%. Europe is basically the same, and monthly it's also very low. So let's see binary outcomes: 0 to 1, 0 is bearish, 1 is bullish. So based on the macro foundations, for me, on a market implied basis, I'm not seeing the equity strength continuing. You can also look at these charts here, where we can see that the stagflationary environment basically continues since September of 2022. And as well, you can see on the right side the weekly changes in the regime probability. So into year end, we had a slight dip in the stagflationary environment, which is the green line, and a small rise in disinflation as well as reflation. But this did not continue based on the outcome. So I expect prices to fall, in my opinion, but it's pretty tricky at the current state. So if you take a look at this indicator, this is the Bayesian regime ranges. What I try here is I look at the outcomes of each of the 4 regimes, and I basically use a Bayesian regression analysis to adjust for volatility or confidence intervals and due to the expected mean value of each regime per quarter, I try to assess a Bayesian regime range, is what I call it, which moves based on the expected macro regime, and the fat black line is the European index. So what we're basically getting is that for the stagflationary environment, we are at the top of the range for quite some time, but you can see also the tendency to move in a downward sloping curve. And what I basically would like to say is that based on this analysis, and we are moving to the upper bound, the probability of a mean reversion, either to the mean outcome, to the red line, or to the lower confidence interval, is very high at this current stage. So also another indicator for me, which looks quite bearish. And next is the nowcast for GDP and CPI. So this is a monthly nowcast where I use some interpolation for the GDP values. So I get or basically I can use the monthly data a bit better. So for now we are getting that GDP for the European countries is at 1.99% year over year. CPI is slowing down based on the macro monthly macro data. So everything is going lower, as well as the nowcast regime probabilities, which show a disinflation regime. So all in all, what is a clear fact is that for me is that growth is clearly slowing down, and some facts on some of the factor data. So exports are declining on the first difference basis of the rate of change data. M2 is declining, retail sales are down, and lending to non-financial companies increases, which basically is good until it's not good. So if private sector credit increases too much, it basically distorts the growth outlook, which based on Minsky's theorem is where I like to look at private credit, which I did in my last market talk, where we should see private debt to GDP ratios above 150%, or in some countries above 200%. And on a macro basis, this is clearly a risk signal to me as well, that we're approaching a cycle in which private credit is most likely to be going down. So this goes together with the market implied analysis. But for the macro data, I don't get the inflationary signal. It's basically due to the lag of the monthly data, which I try to incorporate in a one step ahead forecast. So what I do is I use some Bayesian vector autoregression as a time series model. Try to look at each individual time series, and I try to use a one step ahead forecast. So the correlation with the one step ahead forecast, or if we look at some forecasted error, it's pretty good. So the correlation is upwards of 90%, and the forecast error is really not that high. So it's a pretty good indicator. And I did not change the image. Sorry. So GDP is at 2.11. If I look at the nowcast, and CPI did not change. So basically, if I use a one step ahead forecast, I get the same exact regime outcome based on the monthly and macro data. Disinflation is strongest regime in either the exact outcomes, or if I look at my probability outcomes. So then I tried a more forward-looking forecast, based on the exact analysis I tried to elaborate on. And you can see in the blue line is you can see the GDP forecast, which is quite shocking to me. If this model proves to be correct in the next 6 to 8 months, then we should expect a GDP of around -5 to -6% year over year. This is clearly recessionary. I know these exact forecasts, they have clearly a lot of variance in there, but the directional forecast of each individual time series and comprise them all to the model outcome points to the same picture.
Yeah, it
That,
looks very bullish, no? This is very bullish for
if you
Europe
flip
now.
the y-axis,
Yes.
yeah. But I wrote an article on my Substack, which was about energy policy and its effect on GDP, where I use electricity consumption to look at the effects of GDP or its relationship. And alone with electricity consumption for the Eurozone, the correlation is like at 0.7 to 0.8 based on the time frame. So if you look at policy errors or mistakes, in Germany, they told us, or basically they said you need to lower your electricity consumption and energy consumption by around about -10 to -20% in a year. So if I use this relationship, you can have it's a simple verbal model, not that hard, but it's exactly this range that I would like to assume. So yeah, this proves to be correct. I don't know. Forecasting error is pretty high if I look at 6 to 8 months, and the variance is pretty big, but general direction seems to be right in my opinion, and was right the recent 6 to 12 months in the forecast. So with the monthly model, you can look at the European regime probabilities based on the GDP forecast, and what we are seeing is that the disinflationary regime becomes much more present in the second half or Q2 of 2023. So we're moving out of the stagflationary regime into a disinflationary regime, and growth cycle is or continues to slow down. So this is my European forecast, and if you like to look at some data points, which I use a Mahana-Lobis score, which is a distance measure, and you look at year-over-year data with a 3 months average. You can look at some sectors like credit, foreign trade, housing, industry, labor, and I try to, based on the distance of the recessionary phases, I like to give a certain point. If the data goes lower, it's pre-recessionary, and if it continues to go lower, it's at recession levels. So what I basically get is the survey data looks not that good. Everything else is basically at pre-recessionary levels or pretty strong pre-recessionary levels. What is of concern is if you look at the last survey data, is the leading indicator, which is by the OECD, and it shows since September 2022 it goes into recessionary levels. This is actually pretty good, well, which I use as a growth indicator for the regime probabilities, and you can see that it has a pretty strong correlation with equity returns and as well as with GDP. So this is quite concerning for me, and maybe it proves to be right with respect to the GDP forecast from the earlier chart. And with this distance measure, I try to assess the recession probabilities in for now and to plus 6 months. And you can see that it's not nothing. So if you look at the left chart, you can see that it's clearly rising. Each individual time series is rising. And this is, if you look historically in the right chart, this was often a sign of economic downturns or basically or probably a recession. For me, this is also another point of being bearish for equity returns for the next 3 to 6 months. So if for a longer period. And yeah, I'll try. So much charts. Okay, all right. Another time series scenarios I like to do is a leading indicator analysis. There I try to use 20 different leading indicators by the OECD with 20 different countries, so I get a global interaction and try to simulate the forecast with respect to each individual time series and their core movements. So this would suggest that the leading indicator declines into mid 2023. Then it should bottom based on this approach, and either it stays lower, or it goes lower, or it continues to increase. So this will be much more important, in my opinion, in 1 or 2 months. If leading indicators try to or start signaling in upward movements, so we could position ourselves then to some equity or some small caps, in my opinion. But for now, this is another indicator which looks bearish to me. If I use a one country model, the leading indicator forecast is even worse. It looks like leading indicators could decline into mid 2023, but much lower, into the 95 range, which is lower than 2008, and probably or maybe same level as the COVID crash. So as with the forward-looking indicators, or basically the forecasts, variance is high, but the mean outcome would suggest that we are seeing no growth into mid 2023. And on the right side, you can see the back-tested stock returns on the index level, which is an European index by which I use from FactSet. So it did get pretty low if you look at the chart with respect to the stocks 50. So I basically see is a high volatility in stagflation and disinflation regimes, and low volatility and rising equity or rising stocks in reflation and real growth outcomes. So that's pretty simple. Another one is financial conditions. This is a financial conditions indicator, which is it's the blue line, which is basically interest rate spreads, and I try to look at if it crosses a certain line, and if you look closely, you can see that we are in very tight financial conditions based on the spreads. If you look historically, you can see we are in the red section in 2000, 2006 to 2007, as well as 2010 to 11, which were all recessions or growth downturns. We stayed there for quite some time. for 2022 or in 2022. So this is also not that good based on the forward-looking growth outlook. So also another bearish signal to me, and it's probably the last model I would like to show is this is what I when I write on my Substack as the recession watch. It's basically a recession indicator based on interest rates and interest rate spreads. And with this, I also tried to look at the growth cycles. So on the left side, you can see the falling growth probability in blue and the index returns year over year. And you can see there's a pretty good correlation on a daily basis. So it's at negative minus 0.5 based minus 0.5, minus 0.4 to minus 0.5. And if you look closely at, you can see in 2006 to 7, you can see a growth dislocation where the falling growth probability clearly goes or moves into the 100% range. And soon after that, year-over-year returns crashed, followed. And this is basically, if we're moving into this into such an environment, we can see right in this area here that we're having another growth dislocation. On the right side in the chart, you can see the latest data points. You can see that there's clearly a growth dislocation. So I have I try to model an indicator where I use an enrolling regression based on a yearly basis, and I look at correlations and their implied index year over year, which looks pretty good. You get some pretty good signals out of there, and the latest data showed that there's clearly a growth dislocation where correlation is very low based on the overall time series, and the implied index year over year is also much lower than based on this index at right around 0. So I expect, based on this indicator, I expect equities to fall in year-over-year terms. So, and if you want to look at the growth probability, you can look at some spreads between corporate bonds and government bonds, or overall bank financing rates. So Euribor rates are a pretty good indicator. It's a pretty good, for me, it's a pretty good way to track the implied growth probability, as well as the recession probability in this model. It's pretty volatile, so I need to have a look at the model. So I get this, so I try to get this one a bit smoother. But we're seeing that we're moving way past the 0%. We're having high spikes of recession probabilities in the Eurozone. So based on this, I expect this recession probability to move upwards, to stay at a pretty high level. If I look at moving averages, I like to look at a threshold value of 20%, and it's clearly above that. So this signals to me another stress indicator for the Eurozone, which could be an indicator that a recession is near in Europe. So, and the biggest driver of the recession probability in this model is the 10 3-month spread and the difference in interbank funding rates and with respect to their time. So yeah, and that's basically all I would like to say.
Chris, I got a question.
Oh,
Yeah.
Okay, so at the beginning, just make sure I get this right. At the beginning, you were showing something that was showing stagflation for Europe. Was that like backwards looking, and now you're casting is for deflation, disinflation?
The the first indicator on the weekly regime probability, this there I use daily market data. There's I think 38 factors, and based on this, I try to look at a basically market implied regime probability with the monthly economic data. It's basically backward looking if you don't forecast it to a certain point, because I update the model for the GDP and CPI nowcast basically every Thursday, and it's much slower in my opinion. And also there's some certain a certain disconnect between market implied regime probabilities and also the economic data. So for instance, I get the disinflation regime downcast for like 3 weeks, I think. And in the market implied, I also saw, if you remember the last market talk I did, I also saw a disinflationary regime in Germany. But I try to keep up every time I update the model, I retrain it, and it indicates for me now, based on all of the data, that stagflationary on the weekly regime probability is also the current regime. So maybe we are seeing another inflation burst.
Okay, so the difference is the stagflation signal you're getting is market signals plus economic data that was from the past month that's just coming in now, right?
Yes. Yeah.
And then
that's basically it.
Disinflation is your forward looking, what you think we're going to go to.
Basically, yeah. With the nowcast, I try to use the 1 step ahead forecast as well as the overall GDP forecast for a longer period, like +3 to 6 months. And this is forecasting me a disinflation regime, okay, or disinflationary regime.
Yeah. So with that, and with Christine just starting now to hike and do QT, what does that mean for the euro? So like, I'm thinking more just like with us being in stagflation right now, we get a PPR number tomorrow, we get a CPI number for the EU later this week. Like, I'm trying to think, like, how does this regime, us going into recession, actually cause pressure in Europe? Like, what does Europe need right now to dump the euro, dump the DAX, with, you know, given your probabilities of where we're going? Like, how do you view that?
So for me, it's basically if they have a lot of inflationary pressures, and if they hike, they don't get inflation down based on the energy load. It's they crush demand. It would drag down each economic indicator, in my opinion. And I think with the GDP nowcast and as well as the European market regime, it's, for me now, it's like a forward-looking indicator. I see the growth dislocations. I can see that the European indexes, they are not behaving in a certain way that they reflect a no growth regime. So in order to bring this thing down, they need to keep doing the same stuff they were doing like the past 3 months, in my opinion. It's for Europe, it's in my opinion, it's really pretty bad. They got pretty good luck that in Germany it was basically 15 degrees last week. So and the energy situation continues, this will, in my opinion, drag down GDP all in all. And for the I'm pretty bullish the dollar based on the regime outlook. So yeah, relative strength for dollar is, for me, is pretty high. Overall, DXY should continue to rise, in my opinion. And for the Euro USD, I think it was some of the most crowded long, if I'm correct. And I really don't expect anything from or I don't expect a rising environment for the euro.
Okay,
Yeah.
so you think that even with Christine doing the hiking this late in the game, that's actually going to hurt the euro in the long run because that's just going to hurt growth even more.
Yeah.
Okay.
Yes.
And then
Basically.
what do you think about European bonds in that aspect? Because like once Christine started talking about the hiking, you had like French bond yields, French 10-year, German 10 years absolutely ripped. They bounced here for the last couple of days. Like, do those keep coming under pressure, or when the euro starts to fall, do German bonds bid, or are we going to get like stocks down, bonds down, euro down, all in Europe? Like, what do you think about that?
I think that as for me, it's like if I would like to choose some or buy some bonds, I would basically look at the US. So I think 2 year have a much better future outlook for me. With respect to the Eurozone, if I look at Eurozone as a whole picture, I can see that we're having countries pretty high in or they have a pretty high private debt to GDP, and they have a lot of risk. If we look at Italy, B2B bond spreads, they are pretty extreme. I don't have the exact number currently, but I probably would stay out of Europe for the next 6 months ahead. It's if I assess my macro models, it would be the easiest short, I would say, all in all, and it probably was the easiest short if we look back 6 months ago. So that's my opinion. Stay out of Europe, and I think I would move capital into US 2 year bonds, and as well the dollar for a 3 to 6 months time period.
Before we move to Vi, so one reason we asked Christopher to focus on Europe today, even though I would guess most of our audience is from the US, is because one, Europe has been the most difficult markets to trade. It's been like this since the bottom in October, and because the talking heads in Europe have been talking about a mild and a quick recession. So the data brought today by Christopher is pretty clear. I mean, you could see like minus 20%, minus 40% expected year-to-year return on the European indexes, right? So that's what we are looking at. So
yes, could be possible. And my family is in the real estate business, so they are looking currently at heating costs. And if I look at these price increases, it's pretty. It's like they have tripled, quadrupled in the last year. So the burden for each individual here in Germany is it's crazy. Some people, they cannot afford their housing anymore. If we talk to the bank here, they said that they have so much credit from the Corona shock, and now they need new credit to even keep their business alive, based on the overall heating costs, electricity prices, which were up significantly. And in my opinion, even if this is clearly something I would like to look at is government expenditures. If you look at the recent recession periods. You can look at private sector debt to GDP ratios as well as government debt to GDP ratios, and you can see a pretty negative correlation. So each time recession happened, government stepped in big. This was the further, or this spurts growth for future economic cycles, and this is basically what they need to do in order to keep some things running, especially for small businesses. But this is all verbal, and it's it's, for me, it's better to look at now costs as well as market implied things. It's better than verbal analysis and talking. So you have some hard data to look at, in my opinion.
Right?
Yeah, so it was very interesting, and yeah, I will try to be short, quick. I mean, and short, so bearish. So I will share my screen. I'm still 100% in cash. I mean, I traded today and yesterday, been pretty active, but I still don't have overnight risk, and I will. I think I will start from the main reason why, which is, as Brian said, Hurst exponents. And if we look at a 3 month, because for 3 month, I wanted to be very high. I mean, I wanted to be very high, and the only thing what I see is bonds, and actually from my perspective, how I look at the reverse exponents, actually values above 0.8 can mean that basically we are approaching the end of that strong trend. I mean, not necessarily that directional, but strong trend. So I was trading futures on fixed income as well, in and out. And of course, TLT reflects that very well. So, yeah, but I don't like being in the environment where we have a 3 month Hurst of like 64, 65 for things I like to trade the most. And currently, of course, things like oil and NASDAQ are great for scalping. Basically, that's the only thing what I do. So I'm waiting for signals, especially for a 1 year signals of Hurst to go a lot higher. So here we have a 1 year Hurst exponent, which is, well, exactly what Brian said. I mean, not cool. Not cool. We have a QQQ SPY at 0.6. Well, the only gold. So I don't know, Raphael. Maybe Raphael is trading gold. I am not trading gold. So I hope you saw that and you knew what to do. But basically, for now, we are still quite choppy. But compared to our previous market talk, I'm getting a bit more positive about the outlook. It means that maybe we are close to the point where it will be a good idea to start building short book or spreads, long short spreads that are bearish. So let's take a look at momentum, and the momentum of SPY sectors will basically tell you the whole story. That five-day momentum is what we have. So bonds 0.87 are quite good. Energy is terrible, so XLE is terrible. But now let's just take a look at the most important thing. So IWM after today, of course, is not strong, but has a positive momentum. So from my perspective, it's very important to see what will happen tomorrow, because if that continues, it's definitely not a good sign for bears. And SPY basically neutral momentum at all in those 5 days. So even after today, basically nothing important happened. And in 2 weeks, the same story. I will be very quick, but SPY is a nothing burger. I mean, it's hard to tell whether it's bearish or bullish because it's totally neutral. It has no directional momentum at all. So for now, I don't like that. But of course, if you look fractally, so if you look at different time frames at the same time, you will see that we are still, of course, in a negative momentum territory because IWM minus 0.7 and SPY is also negative. Only bonds are positive. Basically, Bitcoin has 0. Awesome. Okay, so the main reason why I'm not trading that, but now I will show you the reason why I am more positive about the outlook and that maybe we will have an opportunity soon to open some trades that are not day trades, but maybe for a longer period of time. So, of course, dollar correlations. 5-day SPY correlation to UUP and dollar stock correlations are very important in my process. So, of course, I want to see a couple of things. So, first of all, dollar momentum, which is getting slightly better. So, yeah, and very negative correlation between stocks and dollars. And you will see from 10-day and 30-day charts that this correlation is negative most of the time. But when I see very negative, I want it to be heading down. So directional changes and direction is important. So now I want this move to end. If you see here, basically, I want this move to end and that correlation to go down on a 5-day basis. Now, 10-day basis, we also see some signals that I wanted to end. So of course we had a great move, but now we have this thing again, and for me it's a no. But the overall correlation matrices look a lot better when we compared to what we saw. So yeah, 30 days. I wanted to go down. Basically, we had those spikes, and of course, we all know why we had, because dollar was crushed, and so now let's go to correlation matrices, and we'll see what I have here. So as I mentioned multiple times, so stock bond correlation and dollar bond correlation are the ones. So now these are made today like 10 minutes or 15 minutes before the close. So basically almost real-time data. So for example, TLT and SPY, what we have is 0.45. So this is good. And this is actually going up slightly, so that's exactly what we want. And UUP TLT is positive correlation, and we had a chat before this video, and Raphael said, yeah, it was negative, now turned. So I expected, honestly, now I expected to become negative again. Of course, we'll see, but if I see that this change in short-term correlations is not strong, I will consider searching for places to short things. And by things, first I will start from IWM and QQQ. So I'm still not sure if I will start as a spread. So XLU IWM still looks good, but now the more I think about the inflationary environment, and the main question is, will we continue to will we remain in that environment and so on? So I don't know, because XLU tends to not perform very good if we go to the deflationary environment. But of course, that's not a question for the midterm, at least if we're talking about a couple of months. So XLU IWM still looks good, and actually that spread is bullish trend and looks not bad. So I will see. Maybe I will pull the trigger if we get another dip, and it's actually dipping. So yeah, maybe. But yeah, the most important thing for me now is UUP TLT correlations, because SPY TLT, so stock bond correlations, I mean, it's nothing new that they are now positive, because we all see what happened. We had quite a rally in TLT. Also, we had quite a rally in stocks. By rally, I'm talking from lows. So don't get me wrong, I'm talking from lows. So of course we had quite big rallies. So it's good that we have this positive correlation, but of course, still from a regime perspective and what my our signals are saying, of course, the direction needs to be down, not up. So for now, I'm just playing that chop and trading futures, but for my spreads, they will be directionally bearish. So even if long, short, but it would be things that basically on a short side, there will be things that tend to fall most in those regimes. So IWM is a good example on that. So these are the correlations. Now I just wanted to give you a quick bonus and to show what signals are telling for tomorrow. So this is my fractal range upside downside ratio for tomorrow. So it's a regular range, not long-term range, and the colors of bars are trends. So of course, if you have a process like me, where one of the most important metrics in MFR regarding trend is upside downside ratio, you will see that not a lot of longs, especially from equity sides. So because majority of bars that are green have upside downside ratio below 1, and the only rebel, which is XLE, is of course the one that we don't want to short because of bearish trend and because of what you guys were talking today, because the macro views on oil are also not very supportive, and especially it's not oil. I mean, you still get equity risk. So nothing burger. I'm sure that tomorrow I will continue to watch and maybe trade futures, but at the same time, the main difference, I'm starting to look into my watch list and refreshing my spreads every single day, intraday, and now I will not be very concerned to open some trades, because I think that this so-called BMR period is over, or if it's not over, it's very close to being over. Yes, so this is encouraging for me, because when I put all those signals together into one broad picture, I see that okay, maybe now it's time to have some fun again, like we had before October, let's say. Yeah, so I hope I'm right, and I hope that very soon we will be able to have some fun again. Yeah, so that's it from me.
Okay, good. So anybody wants to add something to the discussion, or some follow-up question regarding what somebody has said?
Vi, what do you what's your biggest trigger for you to short, like to put it on? Do you want Hearst to try to strengthen into a down move, or what's the big thing for you right now?
The biggest thing, well, two biggest things would be Hearst strengthening on a down move and correlations in my favor. Yeah, if I had to say the ones that are the most important for me, yeah. Because correlations, especially when you monitor different time frames at the same time, like we do, so and you do the same thing, so 5, 10, 30, whatever. Then correlations are not really lagging because yeah, if you only watch some bigger time frame or only one time frame, yeah, these are pretty lagging. But when you are monitoring the changes, from my perspective, it's awesome. I mean, it's very important. But of course, for long short trading, I encourage everyone to try building spreads on TradingView and before you enter a long short position. So that's also, I remember that years ago, it was like 4 years ago, I first started looking into the market based on spreads, not as separate positions. When we're talking about long short book, and I mean, it changed a lot for me. So that is also so if you have an idea, and if it's a long short book, I recommend you first to look how the spreads of that thing against other things you have look. So but this is more of a process thing, not a signal thing. Yeah.
One spread I've been watching a lot, probably a lot to watch, is high beta, low beta, so SPHB over SPLB, and that one,
Oh yeah,
it's gone nowhere since May, which is interesting because we know who covered in May, and it's finally really starting to move. Like in this recent drawdown, the last 2 weeks of December, high beta significantly underperformed. So I'm curious if you've been looking at that one at all, if you have any thoughts.
yeah,
about that.
I have this in my watch list as well, and I would say that the reasons most likely are very similar to the reasons why XLU IWM looks good and not bad. So it means what market is thinking ahead, forward looking. I mean, so XLU IWM basically told us that market, even though if inflation numbers are falling, let's call them this, but market is not expecting real deflationary environment. So with this also, yeah, even though we had quite a good period for stocks, let's call it like that. I'm sure people will understand what I mean. If from bottoms we had quite a good period for stocks and so on, but the spread says that majority of people, even if they are buying, they're buying less of the more risky stuff and more of conservative stuff. So it can be a good forward-looking indicator, the behavior of the spread. That's how I view those things, because of course you expect, for example, when there is a BMR market is booming, let's call it booming again, you expect high beta to outperform, basically, because people are buying things like tech, whatever. But when you see that it's the other way around, you see that, okay, so maybe market is not thinking that things will boom, that things will continue to boom. So that's how I look into those things.
Nothing else, guys?
No, and we have a chat, but I see that nothing is there in the chat.
Yeah, it's like the last time. We have like 25 people coming in, but then people they watch on YouTube the last one. Yeah, we got like 268 views on the last one. So not a lot of people tune in for the live, but they watch afterwards.
I would like to share a quick thought. Basically, it's a back test of the recession probability model, which basically can be useful. So if you zoom in, you can see that under the column returns index, you can see if the probability is below 20, if it's upwards of 20, you can see the returns. Also summed up for global, and you can see R squared for accuracy. This is the recession probability based on the interest rate model. So it works pretty good for some of the countries. For the European Union, it's not that good, but accuracy of the model is pretty high. You can also see that its recession probability for Germany is very high, and the back test with over 6,000 observations is pretty good. So 368.5% if it's below 20%, and probability is elevated above threshold value, it's minus 167. Same goes for falling growth probabilities, and this is where the European Union, the back test works pretty well. So yeah, you can see if the probability is below 50 or if it's upwards of 50. So this works pretty good for European Union as well as the UK, and that's why I like to look at this simple model, because interest rates, they tell us quite a lot, in my opinion, and especially the spreads. So for the last chart.
That's pretty good.
What's the bet,
Pretty good.
Raphael?
Sorry?
What's the bet?
I have 3 possibilities. So you let me know which one you want to do. One is the VIX lower base. Another one is DXY bottom in. And the last one is as gold topped for the next 2 weeks.
Let's do all three.
Okay. Okay, so VIX lower base. So 21, 20, 19, 18.
Right here, 22.
Okay.
I'm close to that, but I will leave some room, so 21.
On a closing basis, right?
Yeah, sure.
Yeah, of course.
Ram,
21.
I says 21. I mean, he's never been that close to me on these bets.
it's crazy. I mean, he's like, I'm feeling much better with my shorts right now. Ram, are you worried?
No, I'm not. I see the VIX going dipping below 21, getting close to 20 actually.
Okay.
So what's your bet? 20?
Let's say 20.5.
Okay, we go with the 20 with S. I don't know how you say in English. 20s, right?
Okay, yeah.
The base 20s.
20, yeah, so between 21 and 20, that's my range.
I'm
20s.
going with Ram. I'm going with 20s also.
Yeah.
Donkey.
Chris Donkey.
I'll be bold here. I'll say 18s. I think we're going back down.
Okay.
I think we're gonna get another swing at it.
Don't do it to me, man.
I can see that. It's not the next 2 weeks. Are we talking about the next 2 weeks? I don't see that happening in 2 weeks.
Yeah,
Yeah.
2 weeks. Yeah, 2 weeks.
The next 2 weeks. He's still saying
Next
18.
2 weeks.
You're going.
You hold
you're
that
going
bet,
to bold.
Donkey?
I'll say 19s.
Okay.
That's still brutal.
I would also say 20.
20,
I would also
okay.
say a bit lower. Recent price action was pretty
Okay.
bad.
Is DXY bottom in? Yes, no.
Yes.
Yes. Also yes.
Again, I will say because I want it to be, so yes.
I'm gonna say no.
Donkey?
If DXY doesn't bottom, Raph, where's it going?
Huh?
If Dixie doesn't bottom, where's it going?
It's pretty bad. It's pretty bad. I mean, I saw.
I'll say bottom. Yeah.
Okay, yeah, you say bottom. I saw what the range did on my volatility range when volatility increased. It was not pretty. It was I think like at least 2% lower. It was crazy. So let's hope volatility on DXY has stopped rising. So I'm gonna say yes. And the last one was as gold topped for the next 2 weeks.
Yes.
I hope
I
so.
will put it. Okay, Ramadan say.
I would say yes. I hope so. I want to buy.
Yes, I saw your message. Yeah. Come on.
So if we're talking about spot, I will put it like this. Now I see spot is like 1850 something, so it will not go above 1900. So
Yeah, you are changing the rules.
I know. So yes, okay, yes,
Okay,
but
that's
I
not-
mean, I still see,
I need to
small.
write down the value because then people will argue with the rules.
Yeah, so I'm using spot. It's like 1850 something now.
1850. Yeah, but we have to consider the previous stop. What was the previous stop this week?
Yeah.
Was 65.
Yeah, 1865 something like that.
Okay, we go with this. So then we have Donkey, Chris, and Bri. You have not answered.
Yes, yes, on gold. I mean, it has to, like, if you want stocks to roll over, gold has to roll over here. Because I feel like it's bid for the wrong reason. You know?
Okay,
I would also say yes.
okay. And Donkey.
I'll go with yes.
Okay, I'll go with yes too. Okay, guys, we are good. Okay, that was a longer one than last time, but we talk about market signal. I think it's pretty good to have Chris to talk about macro because this thing we know nothing about, so we rely on this, and it was pretty good. I mean, Bri finally had to witness the potentiality of a minus 40% on the CAC. We've been talking about this for 6 months, maybe.
It'd be great to see. Look, both in the US and Europe, it's clear that it's going there. It's just like, how do we get there? Like, what are the shoes that have to drop? Like, what's going to dump the euro? This is just, it's hard to see it. What's going to be, you know, you pinpoint it.
Yeah. So, yeah. Vi, you want to make the conclusion?
Yeah, so I hope this talk was valuable and you enjoyed it. So thanks everyone for joining. Thanks Chris, Donkey, Raphael, Brian, Ramadan, and yeah, see you all in 2 weeks. So manage your risk and have a great 2 weeks. See you next time. Thank you. Bye.
See you guys.
Thanks, guys. Have a good one.
See you guys.
Bye.